both lower than expected population growth and a lower supply shortfall is slower growth in the working age population. The combination of a plunge in net immigration and a surge in deaths during the pandemic probably accounts for about 1.5 million missing workers. Policies to support labor supply are not the domain of the Fed. Our tools work principally on demand. And without advocating any particular policy, however, I will say that policy to support labor force participation could, over time, bring benefits to the workers who join the labor force and support overall economic growth. Such policies would take time to implement and have their effects. For the near term, a moderation of labor demand growth will be required to restore balance to the labor market. Currently, the unemployment rate is at 3.7%, near 50-year lows, and job openings exceed available workers by about 4 million. That is about 1.7 job openings for every person looking for work. So far, we've seen only tentative signs of a moderation in labor demand. With slower GDP growth this year, job gains have stepped down from more than 450,000 per month over the first 7 months of the year to about 290,000 per month over the past 3 months. But this job growth remains far in excess of the pace needed to accommodate population growth over time, about 100,000 per month by many estimates. Job openings have now fallen by about 1.5 million this year, but remain higher than at any time before the pandemic. Wage growth, too, shows only tentative signs of returning to balance. Some measures of wage growth have ticked down recently, but the declines are very modest so far relative to earlier increases and still leave wage growth well above levels consistent with 2% inflation over time. To be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with 2% inflation. So let's then sum up this review of economic conditions that we think we need to see to bring inflation down to 2%. Growth in economic activity has slowed to well below its longer run trend, and this needs to be sustained. Bottlenecks in goods production are easing, and goods price inflation appears to be easing as well, and this too must continue. Housing services inflation will probably keep rising well into next year, but if inflation on new leases continues to fall, we will likely see housing services inflation begin to fall later next year. Finally, the labor market, which is especially important for inflation in core services ex housing, again accounting for more than half of the category, shows only tentative signs of rebalancing, and wage growth remains well above levels that would be consistent with 2% inflation over time. So despite some promising developments, we have a long way to go in restoring price stability. Returning to monetary policy, my FOMC colleagues and I are strongly committed to restoring price stability. After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy, and I'll close by saying that we will stay the course until the job is done. Thank you.
Thank you very much, Chair Powell. I think you spared me the chore of asking you to pick between 50 and 75, so I won't have to ask you that. Thank you for your last paragraph. But I want to talk a little bit about wages and inflation. So, as you said, wages are rising faster than is consistent with a 2% inflation rate, assuming reasonable productivity. You said in November that wages are not the principal cause of prices going up. But for many workers, real wages have been falling lately. So I wonder, isn't there room for wages to rise a bit faster so workers can make up lost ground? And What level of wage increases do you think is consistent with a 2% inflation target?
Okay, so I guess I would start by saying that the inflation that we saw at the beginning of this episode back in March of 21 was not really related to wages at all. It was related to tightness in goods markets, largely due to supply chain issues. Over time, though, inflation has now spread broadly through the economy. And while I would still say that the inflation we're seeing now is not principally related to wages, we think that wage increases are probably going to be a very important part of the story going forward, particularly as it relates to that third category of core services ex housing. So we think it is an important thing going forward. And ultimately, in the service sector in particular, where wages and benefits are by far the largest cost, wages need to go up. And of course, we want wages to go up. We want wages to go up strongly, but they've got to go up at a level that is consistent with 2% inflation over time, making basic assumptions about productivity. So if you look at the principal wage measures that we look at, I would say that you're 1.5 or 2% above that with current wage increases. So particularly the employment compensation index and the average hourly earnings index. Look at those two. It's are by far the largest cost. Wages need to go up. And of course, we want wages to go up. We want wages to go up strongly, but they've got to go up at a level that is consistent with 2% inflation over time, making basic assumptions about productivity. So if you look at the principal wage measures that we look at, I would say that you're 1.5 or 2% above that with current wage increases. So particularly the employment compensation index and the average hourly earnings index. Look at those two. It's about 1.5% higher than what would be consistent, making various adjustments, including for productivity, from nominal wages. So, and as we look at the labor market today, including today's JOLTS data, what you see is a labor market that there's a real imbalance between supply and demand. There are 1.7 job openings for every unemployed worker, everyone looking for a job. The so-called jobs workers gap is about 4 million, meaning if you look at all of the available jobs, including people who are working, and then look at people who are in the labor force or looking for a job, there's a 4 million shortfall. So you're in that world, and we think that there's a job for moderating demand in there and getting the labor force back into balance.
You don't think that there's a possibility that we should have a period of catch-up of wage increases above the sustainable level, and that businesses with relatively fat profit margins can absorb some of that without passing it through?
So that's the question of the worker share of profits and that kind of thing is not really related to this. Right now,